Hey everybody, welcome to chapter 12, the last chapter. I know there's probably some rejoicing and happiness going on right now, and it's not because you hate accounting, it's just because, okay, maybe you hate accounting, or maybe you're just ready for it to be over. Anyway, so this is a statement of cash flows. We talked about cash flows a little earlier in the course, but just kind of glossed over it, touched on it briefly. So we'll go into it a little more in depth here. Make sure you understand this chapter well, since a fairly big chunk of the final exam is based on it. 15 of the questions on the final exam will be from chapter 12. So let's get into it. So there's the learning objectives for the chapter. As usual, I will let you read them. There's how they break it down. And here we go. All right, so the reason we like to worry about the statement of cash flows is because cash often means a lot to us when we're deciding whether or not to invest in a company, or when we're deciding how healthy our company is, how much cash the company has available to it. And so as we use cash flows, it helps us assess all of the things that shows there on the screen. All right, so cash flows come in three types. We have cash flows that come from operating activities. Operating activities are those activities that happen from our day-to-day operating or running of the business. That includes income, cash we collect from customers, income statement items, so income, and then expenses, money we pay out for the cost of doing business. We also get cash and spend cash on investing activities. Those are changes in investments and long-term assets. So when we buy equipment, buy buildings, buy land, all of those things cost cash. And so those would be changes in our cash flow. Conversely, if we sell off a building or sell off a piece of land, that would bring cash in. So that's differentiated from cash we earn from operating. That's selling and buying the normal things we have to do to make the business run on a day-to-day basis, as opposed to the selling and buying of those long-term assets, which happens much less frequently than operating activities. Finally, financing activity is any borrowing of money or paying in of money by the owners. So the issuance of stock, the issuance of bonds, the issuance of notes, those sorts of things are financing activities. If we borrow money or if we raise equity by selling a portion of the company, those are financing activities. Okay, so I guess this is a further description of what I just said. The kind of most common inflows: sale of goods and services, interest received, and dividends received. Those are cash inflows from operating activities. Cash outflows usually are paying for inventory, paying money to our suppliers, paying our employees, paying taxes, paying interest. Those sorts of things are operating activities. Investing activities, like I said, we bring money in from selling property, plant, and equipment, from selling investments or debt equity securities of other entities. So not borrowing money ourselves, but if we own the debts of other businesses and we sell those, that's more rare. You don't see it all the time. That's investing cash flow and inflow. Collection of principal on loans to other entities. So if we've loaned money to someone else and we collect on that, then that would increase our cash. Normal cash outflows from investing: the purchase of property, purchase of investments, making loans, right? Finally, financing activities. Well, I'll explain it in a minute. Financing activities, our most common inflows are selling our stock or issuing our stock, and the issuance of debt, bonds or notes. Outflows would be paying dividends to stockholders or redeeming long-term debt or reacquiring stock. That's how we would pay money out through financing activities. An important distinction I wanted to make here is when we make loans to other people, that's an investment. So if I, as a business, have some extra money and I loan money to, say, another business, that's an investment. That's not me doing any sort of financing for my business. On the other hand, if I borrow money from someone else, that's financing. I'm financing my business. I'm not making an investment. So those two things confuse people sometimes. I wanted to clarify. All right. Sometimes there are significant non-cash activities and those don't show up on the statement of cash flows. Why? Because the statement of cash flows is all about cash. So if there's a non-cash activity, we usually will put a separate note at the bottom of the statement, like a schedule or a note in the company's report explaining that one of these significant non-cash activities took place. All right, so here's the basic format of a statement of cash flows. It's broken into 3 sections: cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. And we have a choice as to whether we're going to use what's called the direct method for the operating activities section or the indirect method. All statements of cash flow are relatively the same in the investing and financing activity section, but some use one method, some the direct method, and some use the other, the indirect method, in the operating activity section. In this course, we're going to focus on the indirect method because it's used by the vast majority of businesses. All right, so there's a basic format. Like I said, operating, investing, financing. Then there'll be a net increase or decrease. Then there'll usually be the amount of cash you had at the beginning, the amount that you had at the end, and then any list of the non-cash activities. All right, so this slide is a little confusing when you first look at it, and I debated on whether I should even include it or whether I should delete it out of here. But I decided to include it because it really does point out something pretty important. This is how cash tends to flow in a business. In the early days of the business, you see that financing provides most of our positive cash flow. That's borrowing money or having the owners pay in. And that investing, spending money on large assets, land, buildings, equipment, tends to be negative. And operating in the beginning also tends to be negative. As the business grows and gets older, matures might be a better word, you'll see that our cash flows from operating activities begin to climb until they're in the positive. Our cash flows from investing tend to climb, and sometimes they're in the positive. And our cash flows from financing tend to drop because we start to pay off debt. So that's an important thing to understand about the way businesses work. All right, so when we're going to prepare a statement of cash flows, we need 3 sources of information. We need a comparative balance sheet. By comparative, we mean a balance sheet that compares the current period with the previous period. We also need a current income statement, and we may need additional information. In a problem this is given to you in real life, sometimes you have to find it. All right. So there's 3 steps in preparing a statement of cash flows. Step number 1 is to determine the net cash provided or used by operating activities by converting net income from an accrual basis to a cash basis. Okay, that's confusing. What does that mean? It means that we have to recognize that we keep our income statement and our balance sheet on an accrual basis, meaning sometimes we write down income that we haven't yet received in cash. Why? Because we've already earned it. Sometimes we write down expenses that we haven't yet paid. Why? Because, well, we've already incurred the expense, but we'll pay them at a later date. Sometimes we account for the purchase of assets by depreciating the asset over a long time. Well, all the cash was spent up front to buy the asset, but we're showing the expense each year through depreciation. Well, that's great for keeping track of revenues and expenses. It's the best way to do it, but it doesn't give us an accurate picture of our cash. So we have to convert from that accrual basis back to a cash basis so we can understand how much cash we have. Step 2 is we analyze changes in the non-current asset and liability accounts and record as investing and financing activities or disclose as non-cash transactions. So we'll look and say, oh, well, the amount of my equipment increased. What caused that? I must have spent money on the equipment, or I must have borrowed money to buy equipment. So that is step 2. Step 3, compare the net change in cash on the statement of cash flows with the change in the cash account reported on the balance sheet to make sure the amounts agree. All right. Like I said, we're going to focus on the indirect method because the vast majority of companies use the indirect method. It's easier, and well, we'll leave it at that. All right. So here we have the income statement for Computer Services Company. This will be a long, drawn-out illustration, so just hopefully try to follow as best you can. You see they have a revenue of $507,000. They have a whole bunch of expenses. That gives them an income before income tax of $192, income taxes of $47, so a net income of $145,000. Here's a comparative balance sheet for this period, 2014, and the previous period, 2013. And then they've added a third column. And this is important if you have to do this on your own. The third column simply records the increase or decrease, the change in each account. And this will be important to us later as we're making the adjustments to convert, if you will, our accrual basis statements to cash so that we can see our statement of cash, so we can create our statement of cash flows. And then there's a bunch of additional information. That's just the second half of the balance sheet. And then there's the additional information at the bottom. All right, so step one, determine the net cash provided or used by operating activities by converting net income from an accrual basis to a cash basis. So our most common adjustments that we're going to make are to add back non-cash expenses, for example, depreciation. That could also include amortization or depletion, which we haven't worked with much. The idea is this. If I look at an income statement, let's look at this company's income statement, and I see depreciation expense of $9,000. That $9,000 reduces the net income of the company because it's there as an expense. If I assumed that whole net income was the amount of cash the company brought in, I'd be wrong. Well, why? Because at least $9,000 of it is an expense that didn't cost them any cash. Depreciation is an amount that was paid long ago when we bought the equipment. So the first thing we have to do is add that depreciation expense back in and add in all non-cash expenses. Second thing we have to do is deduct gains and add losses. I'll explain those when we get to them. And then third, we have to look at changes in non-cash current assets and current liability accounts. All right. So here's depreciation expense. So again, this is the process by which we, using the indirect method, we figure out the amount of cash flow by looking at the income statement and the comparative balance sheet. So add back in that non-cash expense, depreciation expense. So we start with the net income, and now we're making adjustments to it for those amounts that the net income doesn't represent the cash fully. So we add in depreciation. Why? Because we didn't really pay cash for that expense. Then we look for loss or gains. The reason we have to deal with these is because they'll be reported in another part of the cash flow statement. They're not really operating expenses, right? If we sold a piece of equipment or a building or something like that, then that cash that we got from selling it will show up later in the investing section. We had to include it in the income statement because it affects our taxes, our net income and then our taxes. So what we want to do is account for those by adding any losses that show up back in or deducting any gains that show up back in. So in this case, there was a loss of disposal on plant assets of $3,000. So we add that loss back in. Then we look at changes to our non-cash current asset accounts. So the way they do it in this book is a little confusing, but try to follow, and then I'll kind of give you a rule that helps me do this a little easier. In fact, let me give you that rule right now. So whenever we're making adjustments for asset accounts, in other words, a change in our current assets, we're going to adjust in the opposite direction. What I mean by that is if we have an asset account like accounts receivable that goes up, then we're going to make a negative adjustment to cash. Conversely, if our asset account decreases, then we'll make a positive adjustment to cash. The logic follows like this. If my accounts receivable account climbs, what that means is people did not pay me the money they owed me. So if I collected less than I was owed, let me put this a better way. I think the best way to put it is accounts receivable climbs because people are not paying you. That's when people owe you money. So if that account is climbing, then that means we did not receive all of the cash that we earned during that period. If you remember, we start with net income, and we're making these adjustments to recognize that some of that net income wasn't received in cash. So if our accounts receivable balance is getting higher, it means people aren't paying all of that revenue that we've earned to us in cash. Instead, they still owe that to us. So if accounts receivable or other asset accounts climb, then we reduce the amount of cash for the adjustment. Conversely, if our accounts receivable is dropping, that means people are paying us for all the revenue we've earned, plus they're paying some additional. They're paying down amounts that were owed from the past. So if the asset account drops, then we're going to make that a positive adjustment to cash. Then the other rule is the opposite occurs with liabilities. If a liability goes up, then we're going to adjust our cash up. Why? Because if we're borrowing money, we're going to have more cash. Conversely, if the liability goes down, or not conversely, but if a liability goes down, then our cash goes down. Why? Because it takes us paying cash to reduce the liability. So that's the rule. With assets, we make an opposite adjustment, or an inverse adjustment. With liability accounts and equity accounts, we make the same, or the adjustment goes in the same direction. Now let me walk you through these changes. So the changes to the non-cash current asset accounts. So accounts receivable, let's see, the accounts receivable account went down by $10,000. On January 1st, it was $30,000. On December 31st, it was $20,000. Whoops, sorry about that. All right. So if our accounts receivable went down by $20,000, it's an asset. Remember what I said. If we have a decrease in the asset account, then we're going to do an increase to the cash. We're going to do a positive adjustment to cash. So we're going to add that decrease in accounts receivable as an increase to our cash. This can be confusing. You see, I got a little confused just as I was trying to explain it to you. So you really have to kind of spend some time wrapping your brain around it and understanding it. Let's see. Our inventory account had a balance of $10,000. Remember, inventory is an asset at the beginning of the period and $15,000 at the end of the period. So here we have an asset increasing by $5,000. So we're going to do a deduction of $5,000 to the cash. If you can't remember the why, at least remember the rule. Assets are opposite. Liabilities and equity are the same. Here's a prepaid expense account. Remember, prepaid expenses are also assets. So the prepaid expenses went up by $4,000, which means they had to pay out $4,000 in cash. So we're going to do a negative adjustment to cash of $4,000. Accounts payable, that's a liability. So the liability account, we had an increase in the accounts payable. So we're going to add that increase to our cash. We had a decrease in income taxes payable. So we're going to deduct that from our cash. Here's their little summary. We deal with non-cash charges like depreciation expense and amortization by adding those in. Then we look at our gains and losses. We add our losses back in and subtract out any gains. Why? Because they're going to show up in a later part. and then changes in our current assets and current liabilities. We are going to deduct any increases in assets and add any decreases in assets. In other words, there'll be an inverse relationship when it comes to asset changes. And then we're going to add increases in liabilities and deduct decreases in liabilities, or there will be the same relationship. All right, step 2, we have to look at our investing and financing activities. So we know the company purchased $110,000 of land by exchanging bonds for land. This is a non-cash investing activity. We got that from the notes, gave us that additional information. So this isn't going to show up on the statement of cash flows, but there will be a note at the bottom saying that this happened. See down at the bottom they have disclosure, issuance of bonds to purchase land. From the additional information, the company acquired an office building for $120,000 cash. This is a cash outflow recorded in the investing section. So what they did, if you look at this, they've just collapsed the part we just did, the operating activities, and now it's showing us the cash outflows from investing activities. Negative $120,000 for the purchase of a building. They purchased equipment for cash of $25,000. So there it is. And then they also sold some equipment for $4,000. They took a loss on it and all of that, but really, if you just take a look, what really matters to us is that we dealt with the loss up top by adding it back in, and then we've listed here the sale of equipment and the $4,000 in cash we received from it. So in this company, the investing activities actually used up cash, right? They had a negative cash flow. Then we look at the financing activities. It looks like we issued 20,000 shares of common stock. They were $1 share, so that brought in $20,000 in cash. It also looks like we paid $29,000 in dividends. So that's going to be a deduction to our cash. So our financing activities also used up cash, $9,000 in cash. So once we tally all that up, we have the subtotal from our operating activities, $172,000 brought in. We have the subtotal from our investing activities, $141,000 in cash spent. And the subtotal from our financing activities, $29,000 in cash spent. That gives us a subtotal, so 172 minus 141 minus 9 of $22,000. So that was our net increase to cash. Then we look at our balance sheet and we say, yep, the cash at the beginning of the period was $33,000 and the cash at the end of the period is $55,000. So that matches what it should. And that's step 3. Compare the net change in cash on the statement of cash flows with the change in the cash account reported on the balance sheet and make sure the amounts agree, which is what we just did. All right, a couple of ways we use cash flows to evaluate a company. The first is to look at a number called free cash flow, and all free cash flow is the cash provided by operating activities minus any capital expenditures minus any dividends. That tells us the amount of cash we still have available to use for other things. That's free cash flow. Here's an example, Apple Inc., a company most of you have heard of. Here's their 2011 statement of cash flows. So if we want to calculate their free cash flow, actually, look, that's interesting. On the left, it says calculate Microsoft's free cash flow, but then the statement says Apple Inc. I think people working for Microsoft and Apple might be offended that we confuse these two companies. So we take the net cash provided by operating activities, which is right there at the top, $37,529. I'm guessing that's in millions, although it doesn't say that. We subtract expenditures on property, plant, and equipment, and intangibles, $74,552. Subtract dividends paid. Apple doesn't pay dividends right now, or they didn't in 2011. They might this year. And that gives us our free cash flow. That's it. Also, we look at liquidity. What we have is our current cash debt coverage So you take your net cash provided by operating activities, that's money you bring in through buying and selling stuff, divide it by your average current liabilities, and that tells you how able the company is to pay the debts that their current liabilities, the debts due within the next year. And then the cash debt coverage ratio, which is similar, except instead of current liabilities, you use average total liabilities in the denominator. And that's it. So hopefully you can get through the tough spots in this chapter. The toughest spot is just understanding those adjustments. That seems to be the hardest thing for everybody. Spend the time you need to really get that stuck in your brain, how that works. And remember the basic rule when you're doing the adjustments, which is when you're adjusting for changes in current asset accounts, then you adjust in an inverse way, meaning if the asset account goes up, adjust cash down. If the asset account goes down, adjust cash up. And if you're adjusting for current liabilities, then adjust in the same way, meaning if the current liability goes up, adjust cash up, and if the current liability goes down, adjust cash down. The more you work with it, the more it makes sense. So good luck. Let me know if I can help you, and have a great week.